our thinking has been that the market would dip before the midterm elections, not because of the midterm elections, but because this backdrop of the Fed hiking with a lot of global uncertainties, particularly because of trade. That's why I wanted to be in front of you this morning. My thinking is that this is a dip that's already a little bit oversold in terms of versus S&P fair value. But I think we have just a little bit more to go downward before we bounce higher, because U.S. equities are not oversold versus foreign equities. Europe is being beaten up quite badly, 15% decline from its highs, and emerging market Asia on the pressures of these tariffs, which we think are going to get worse, that is down well into bear market territory.
Darrell?
So I actually would agree with David, and I think what's interesting about yesterday, if you paid attention to the market action of yesterday, is that it was really tightly contained in equities. So when you looked at, everybody wants to talk about what happened with yields yesterday, the yield curve actually steepened. That's a bullish sign, right? And we're at 32 basis points now. You're heading into a good seasonal point of time, obviously November, December, into the spring. And if you look at the signs of stress in markets, right? Credit default swaps, OIS spreads, very well behaved, right? They just didn't show the signs of stress. So when you get that type of action just in equities, I agree with David. I think it probably creates more of a bullish sentiment against the fundamental backdrop. The other point I would make, too, about the Fed is, remember, it's not just the Fed that's tightening, right? You've got, interest rates going up, you've got balance sheet shrinking, but you've got oil prices until 2 days ago were at 4-year highs. You've got the U.S. trade-weighted dollar up 10%, which is a tightening or constraining of financial liquidity. So there's a number of factors at play here that are all working to tighten financial conditions simultaneously.
Plus the...
I agree with that.
Yeah,
I just would add to that this isn't about GDP. The market is taking concern with the earnings outlook for 2019. So in my view, Chair Powell is very right to be confident about the expansion, but should be more cautious about just how fast and how high the Fed hikes rates over 2019. As the global economy is going to decelerate, the U.S. economy will be fine. These tariffs are irrelevant for the U.S. economy, inflation, but however, they're significant for earnings. And I think you're going to hear from companies during third quarter earnings reports that the 2019 earnings estimates are too high. And with where these tariffs are going, and with where the dollar is likely going, a bit even higher from here.
Wasn't it?
I think earnings growth will only be 5% next year.
Wasn't it 8 days ago that we hit an all-time high in the Dow? Am I wrong about that? Was it October 3rd? Today's the 11th.
This is what happens.
So just to be clear, what's happened to Fed policy in those 8 days?
We're only 5% off a Fed high. But what's been more dramatic is the bond market. If you look at what happens,
I have a lot of sympathy with the argument that it's not the amount of the move; it was the speed of the move.
Right.
But ultimately, the change in the outlook, it's earnings, it was stronger growth, it was a strong consumer. Yeah. There were all these good things happening 8 days ago. I go on vacation and I don't know what happened.
I'd be more concerned if we saw the equity sell-off yesterday and a curve flattener, right? That and a big rush to flight to quality, driving yields down across.
Why have we seen the financials react to the positive slope, or as you said, the increase in the yield curve?
Well, they actually did, Steve. I mean, they on a relative basis perform much better than a lot of the what you call long duration assets, right? So, obviously tech is a long duration asset, consumer discretionary.
Yeah, but forget about it on a relative basis. We should have seen them. We've seen nothing but flattening of the yield curve. Now we see the yield curve start to steepen. Are they more concerned with lack of growth going forward versus a slight steepening?
That's a very fair point, because credit growth has been the concern all the way along, and net interest margin spreads all the way along.
Okay, but because you're